Hey everybody, Tim Albrecht here. And before we jump into today's episode, I have to take a minute to let you know about an incredible offering that makes up a huge portion of your financial pharmacist. And that is our fee-only comprehensive financial planning services. Now, I remember feeling lost and frustrated after graduating from pharmacy school. I was buried under $200,000 of student loan debt. And while I was making a six-figure income as a pharmacist, I felt as if I was living paycheck to paycheck. I knew I wanted to save for retirement, fund my children's college savings accounts, build wealth, and so much more, but I did not know where to start. The truth is, it doesn't have to be this way. With more than 230 clients in 40 plus states, our team of highly trained certified financial planners is experienced in offering an honest, education-focused approach to financial planning that is customized to help you, the pharmacy professional, feel confident in your walk towards living a truly wealthy life. So whether you are a new practitioner wading through six figures of debt, a seasoned pharmacist, or are approaching retirement, our financial planning services are designed to meet your needs and goals. To learn more about YFP Financial Planning Services and to book a free discovery call, visit yfpplanning.com. Again, that's yfpplanning.com.
I'm not incentivized to put someone in these mutual funds because I don't make a commission from that. So what I'm incentivized to do is to put the client in the best situation across the board, but particularly for the investments we're talking about, where they're paying the least amount for the most gain.
You're listening to the Your Financial Pharmacist podcast, a show all about inspiring you, the pharmacy professional, on your path towards achieving financial freedom. Hi, I'm Tim Albrecht, and this week, Tim Baker joins me to talk about the F word that we want to minimize when it comes to our investments, and that is fees. When you do the hard work to save money, you should be interested in keeping as much of that investment intact as possible by minimizing the fees that can take away from your long-term gains. On this episode, Tim and I discuss the various types of fees you may be paying, and perhaps some you weren't aware existed, when these fees may or may not be justified, the impact these fees can have on achieving your long-term savings goals, and strategies you can take to evaluate your fees related to your own investment plan. Tim, back-to-back episodes. Good to have you on again.
Yeah, good to be back. I'm excited for this episode. I think it's going to be hopefully valuable for those that are listening.
Yeah, I think so. And we talked last week about common financial errors and mistakes, some that we've made, some we've seen other pharmacists, clients, colleagues make. And today we're talking about one that was not on that list of common mistakes we discussed last episode, but certainly can have a major impact on how much wealth you're able to build. And we're gonna talk really big numbers at the impact that fees can have. Fees on the investments is going to be the focus of today's discussion, and hopefully shedding some light on a topic that maybe folks have heard about, but haven't really thought about and evaluated for their own investing plan. So, Tim, one of the things that I share when I talk on the topic of investing is that, if you're going to do all of the hard work to save money each and every month, to take advantage of compound interest and the time value of money, that we want to do everything we can to maintain as much of the pie as possible. And I often think that there's, really three big things that can eat at our investment pie. That's taxes. And we've talked about that on several episodes on the show of things that we can do from a tax advantage investing standpoint. Inflation, obviously, can be out of our control to some degree. And then the third is the one we're going to be talking about today, which is fees. And something I've heard you say before is that you need to follow the 3F rule of 401k management. And that's figure out the fees first. So that's what we're going to be digging into today. And that's even beyond just the 401k when we talk about fees. So Tim, before we get too far into the weeds about this discussion of fees, let's back up a bit, as some may be thinking, fees on my investments. What fees on my investments? So talk to us a little bit about the common fees that are out there when it comes to one's individual investment portfolio.
Yeah, and if I could even back up further, Tim, I would even say like the importance of this, like it shouldn't be understated. Like, and I think that when we kind of like when I talk about baby stepping into the financial plan, we look at things like, what does the emergency fund look like? What does the consumer debt look like?
Yeah.
When we dive in particular into the investment part of the financial plan, one of the first things I look at is fees. And, outside of the asset allocation, which the asset allocation being, how do I divvy up, in a broad sense between like stocks versus bonds. And you can actually get more granular than that. Outside of the asset allocations, the fees probably play one of the biggest roles in your ability to kind of build wealth over time. And really the fees, just like you mentioned, along with tax and inflation, is it can really be in, a factor that erodes that ability to build wealth. So it's super important. And, when I look at the fees, one of the problems in the industry is that the industry is not super transparent with regard to what the investor pays. A lot of these can be wrapped up in products that are sold to investors, or not necessarily, appropriately disclosed on a statement. So you're really up against it when you're trying to figure out, okay, what exactly am I paying? And the fact that it can be a little bit opaque in that regard is frustrating. And I think that's one of the things that we work with on clients, is to show them, hey, did you know that you're paying this in your 401k? And most people are like, I had no idea. And then the second question is that good or bad? And I'm like, well, it's typically higher than what we see, or, something along those lines. So to me, the name of the game is really trying to understand, to answer your question, what are the things that you could be charged? And then like, what is that exactly for your particular case? So if we look at the things that we typically see, if we look at the 401k first, the things that are typically in the 401k are things like platform fees. So this might be where Fidelity or Schwab or someone might charge you a fee just to really have an account with them. And that's less common in a 401k. You typically see them more in brokerage accounts, more in IRAs. When I was in the broker dealer world, we would charge, the custodian would charge clients just to have an account open. And a lot of this is in also response to like lower interest environments. They're trying to make money where they can. And sometimes these additional line item fees are created. Things like trade-in fees and transaction fees. So this is like anytime that you buy and sell. Again, typically you don't see these inside of a 401k, but you do see them these outside, like of a brokerage account, an IRA. If you buy stock ABC, sometimes you'll be charged anywhere from $7 to $50 a trade. Now, these have kind of become less and less common as a lot of the custodians want to be competitive, and they'll waive fees and things like that.
Race to zero here,
exactly.
Right? It seems
Yep.
like. Yeah.
Yep. The other thing that you would see are things like advisor fees. So these can be both inside and outside of a 401k. So these are things like, hey, I work with an advisor and they charge me a flat 1% on the investments that they're managing. It could also come in the form of commissions, and that's a whole nother kind of ball of wax in terms of how, an A share, a B share, a C share mutual fund, you typically don't see commissions inside of a 401k, but you do see, so sometimes you see C share, which are commissions inside of a 401k, but you typically see those more in brokerage accounts, IRAs and such that. And then probably the last one that basically permeates just about every investment is expense ratio. So the expense ratio is the money that the fund takes to kind of run the fund. So if I'm a mutual fund manager, Tim, and I'm in charge of a large cap mutual fund, I'm managing billions of dollars. So I'm pulling a bunch of investors' money together to buy, large cap stocks and the like. Then I need to pay myself. I need to pay for the fancy office on Wall Street. I need to be able to pay for information. I might even need to, pay salespeople to go out and market my fund. So those all are basically captured in an expense ratio. So the expense ratio basically, takes money out of that fund, and then it's shared. That expense is shared with the rest of the investors that are invested in it. So those are typically the broad strokes. You also see the other ones, I would say, outside, and these kind of can get wrapped up into platform fees, but you'll see like administrative or like bookkeeping fees in a 401k. And this could be, like record keeping and all of the ERISA laws that are surround 401k plans and 403bs. These can be pretty prohibitive. Sometimes they're a flat fee, sometimes they're a percentage, but these are kind of just administrative fees that, again, that are not listed on a statement anywhere. It's just part of the plan and what the plan takes to make sure, it runs, within the laws of, the United States.
Tim, when I hear you say, and obviously it depends on the account. You mentioned some of these may be more applicable to like an IRA brokerage, others, across the board, but several different types of fees you mentioned, right? Platform fees, advisor fees, trading fees, sometimes commission fees, expense ratios, perhaps is the one that folks may be most aware of. My follow-up question here is in transparency and understanding of these fees. So those are two very different things to me. Even if something is transparent, how it's disclosed or how somebody may be informed of it or how easy it is to find that information obviously can lead to whether or not they have a good understanding of it. So in your experience working with clients and really more specifically our clients at YFP Planning, is this something that you find folks are surprised by, and how transparent and accessible is this information to either the individual or you as the advisor trying to work with them?
Yeah, Tim. So I think it is a surprise. And what I typically try to do to kind of make it a little bit more real is put it in like real dollar sense. So, one of the things that, when we talk to like pharmacy schools and we're trying to like drive home the point that, this isn't monopoly money, that when you graduate, you're looking at, with the average student loan debt, that graduates are coming out with, it's a $2,000 payment for 10 years. And when most people think about it in that terms, you're like, oh, okay, that becomes more real.
Mm-hmm.
So I try to do the same thing with the fees. So yeah, like when we go over this, I think at first it's like, oh, okay, well that doesn't sound that bad.
Mm-hmm.
So like I'm looking at this independent pharmacist, their 401k, and typically the smaller the employer, the worse the 401k is, or the more expensive it is, per each participant. So like this particular pharmacist, they're all in when they look at the administrative fees and the average investment fees. It's about 1.27%.
Mm-hmm.
So you're like, wow, that doesn't sound too bad, 1.27%. But if you have $100,000 in that 401k, that's $1,270 per year that the 401k and the funds inside of the 401k basically absorbs. So with this particular client, they have $250,000 in that. So that's a lot more.
Mm-hmm.
It's a lot more money. It's more than double that every year. And again, it's not like it's a line item on the statement anywhere. It's what the 401k takes to run and the investments take, to basically run the funds that they're in. So what we really try to do is, again, look at it. And we have tools that can assess that information. But even to do it yourself, and I've tried to do this even outside of the tools that we use, it's hard to find. You have to find basically the plan. Every year they have to file what's called Form 5500
Mm-hmm.
with the IRS that basically outlines how much money is in the fund and what are the assets, what are the liabilities, if there's any loans, what are the admin expenses, and a lot of those are just a dollar amount that's populated in there. So like sometimes you might see like, oh, my administrative fee is 1.2. And then the next time we like log into our tool, it's 1.4, just because there's new data that's been filed with the IRS. So it's a little bit of a moving target as well. And I think I think I read a stat somewhere that, the average 401k all in expense is about like 1.68.
That's wild.
So
Yeah.
And again, like when I look at our 401k that we've set up at YFP, I think it's less than 0.2. I think, the fees have changed a little bit for ours, but I think when you look at the expense ratio and everything, like it's less than 0.2. So it's a factor of 8. So if I'm paying $1,000, and again, that's a pretty large 401k with that, then like, I don't want to pay $8,000 a year. So those are some of the things that most people, when they say, oh, like 1.2% is not bad, but then when we actually put it in dollar, and then if we then compound that year over year, it really adds up. So to me, the fees are so important. And I think like, I think another discussion to have is like, okay, well, like, are the fees worth it?
That's right. Yep.
And I would say like in a lot of the cases, no. I mean, like, with some of these fees, like you have to pay the fees to be able to like have the fund run and things like that. But in a lot of cases, like if you're paying 10 times the amount in terms of an expense ratio, you're not getting 10 times the performance, or it's not 10 times safer for the same amount of performance. So every type of fee is going to be different on why you would pay this versus that. But in most cases, the name of the game is to kind of shave that down as much as you can to really leave the investments unadulterated so it can grow and really allow you to build wealth over 10, 20, 30 years, whatever the time horizon is.
Yeah, and I think one of the things, Tim, I've heard you say often is that our job, your job, and the planning team's job is to one of the roles is to really try to keep as much of that contribution intact as possible and allow the compound growth to do its thing, right? To really
Yep.
minimize, the fees that are coming out of that. And I think that's so important. Again, back to my earlier comment, if you're already doing the hard work, right, to put away whatever percentage of your income each and every month towards long-term savings, then why do we want to give up, anything in terms of the fees? And that example you gave is really powerful. That independent pharmacist who's got $250,000 in that account with a 1.27%, which is, as you mentioned, is lower than the average 401k. That's a little over $3,000 this year. But as that account continues to grow and compound, that 250 is eventually going to turn into likely 300 and 400 and 500 and so on. And that fee obviously will continue to go up over time. So let me ask the big and nebulous question, like, yeah, maybe a 10x fee isn't worth or justify that you're going to have that value. But is there a place where the fees are justified, such that whatever would be the net return inclusive of fees makes the fees worth it? And how do you evaluate that decision?
Yeah, I mean, I think it's going to sound a little self-serving, but I think if you're paying an advisor a fiduciary fee, a fee-only advisor, and you're paying them, say, whatever percentage out of your investments to be able to do financial planning or investment management or what we do, which is very comprehensive with the tax work and really a lot of different components there. Like, I think that the return that you get far exceeds than what you pay. The idea is that our focus is on more of wealth building and not necessarily just the investments and everything else, but it kind of is beyond that.
Mm-hmm.
When I think of if you take things like expense ratio as an example, I'm looking at a client who, and that same client that was at 1.27%,
Mm-hmm.
I think when we first started working with them, it was close to 2% because there are things that you can control and there are things that you can't control with regard to the 401k. So things that you can't really control are things like administrative record keeping fees. Like, that's just, I always talk about, like, with the investments in a 401k, that's the sandbox. Like, those are the toys that you can play with. There's only 10, 20 mutual funds in there. And it's the same thing, like with some of those fees, you can't really affect change there unless you're small enough that you can, you work for an independent pharmacy and you can say, hey, boss, this 401k is pretty terrible. Can we replace it? For bigger organizations, that's a harder thing to go about. So, you're kind of stuck with those fees. But things that you can control for them, somewhat, are things like the expense ratio. So, this particular client's, her average investment fees are 0.06%. So that's her expense ratio. But when we started, it was closer to 0.8%. So again, $100,000 portfolio, just for this part of the portfolio, she's paying $60 per year, whereas before she's paying over $800.
Mm-hmm.
So the reason that we did that, or how we got there, is that the funds that she was in, she was selecting a lot of the funds that she heard of, like American funds, or I think there was like a Morgan Stanley one here, and
Mm-hmm.
here's a JP Morgan, and these funds are more expensive as in comparison. So I'm in this particular portfolio and I'm looking at the mid cap fund that she was in. It's called a Touchstone Mid Cap, and the ticker is TMPIX. That costs 0.9%. So if I had $100,000 just in this, I would be paying $900 per year. What we replaced that with was an iShares fund that basically is 0.05. So 0.9 versus 0.05. So $50 on $100,000 or $900. So those are things that you can control. And for the most part, there's going to be differences, especially as you get to mid and small and international funds. Like, there'll be some differences in performance and some differences here and there. But for the most part, if I look at those same funds, and I have the data, that says, Over the course of a year, the mid cap iShares that we put her in, it's up 56%. The one that was more expensive is up 33%. 5 years, it's pretty close, 17% with the one that we put her in, 16%. So, the performance, these are things they have to look at, since inception, 10% versus 9% for that. So there are things that you have to look at, but typically the expense that you pay is not worth it. And for things like large cap, when you click into those and you say, okay, what am I actually invested in? So what are the underlying funds? It's the same stuff, Tim. It's things like that we know about. It's Apple, it's Microsoft, it's Amazon, Facebook. It's just that, if you wrap it in a more expensive wrapper and you charge 5, 6, 10 times, just because it's a known entity, even though Vanguard and iShares are pretty known, there is from a large cap fund, it should be very cheap because everyone's invested in the same stuff. So I don't like paying high administrative fees. I don't mind paying a flat dollar amount. So there's sometimes you see it's $80. Okay, that's better than 0.8%. Expense ratio. I don't like paying a high expense ratio. I don't like when when advisors charge commission. I just think that there's a conflict of interest there. So these are typically outside of the 401k. So I think it's okay to pay a fee for professional help, but it just depends on what do you get for that? And, and all the associated fees that come with that. What do you get for that? So if there are 401ks that charge you 0.2 or less, and then there's some that charge you close to 2%, that's a big range over the course of, and are you getting 12 times more value there? And I typically say the answer is no.
Yeah, I think it's just a really good reminder, Tim, that number one, not all fees are created equal, right? So really asking yourself what may or may not be justified with this fee. And then, I think really evaluating and understanding what your current fee situation is and recognizing that some of that may not be in your control, to your point that, especially for those that work for a larger organization, unless you've got the ear of HR and can influence those decisions, that 401k plan is probably what it is in terms of some of those fees. But within the fee options, might you have some control when it comes to expense ratio? And then obviously in other accounts, IRA and so forth, then you can leverage other options to reduce those fees. Tim, I suspect that many of our listeners, especially those that are listening today that have been saving for some time, might be investing in mutual funds through various institutions to be unnamed and are paying substantial fees. And as we've discussed, aren't even aware of it. So I want to take a few minutes to just break down the ABCs of mutual funds. And that's A shares, B shares, and C shares. So can you quickly define the difference between A shares, B shares, and C shares? And then talk to us a little bit about what is the fees or could be the fees associated with those types of shares.
Yeah. So whenever you see A shares, B shares, C shares, what you typically think commission, right? So it's a sales commission for that intermediary, the intermediary being the financial advisor that is selling you a product, i.e. a mutual fund, in exchange for a commission. And I've sold these in the past. So I'm a big proponent of fee only. I haven't always been a fee only advisor. I started in the industry in fee based, which is often confused for fee only. A lot of the fee only people want advisors that are fee based to identify as fee and commission. So when I was in this model, I thought, again, I thought we were great because, we didn't have to sell a proprietary product that was with one of the big financial institutions. We could basically sell whatever we wanted. But the reality is that you want to really work with someone that is not selling on commission, in my opinion, because I think there's a conflict of interest there. So anytime that you have the sale of a product with advice, there's a conflict. So when you hear or see A, B, C shares, and you can typically see this, you can see this on the statement, but it's not necessarily as intuitive as you would want it. So I'm looking at a statement from a very big, institution that I know goes and markets to pharmacists, talks to pharmacy schools. But on the statement, I see the mutual funds that this particular pharmacist was in was a Washington Mutual Investors Fund, CLA. So CL space capital A. So that's Class A, which that's an A share mutual fund. So what that means is that for an A share mutual fund, these are upfront basically fees or commissions with lower expense ratio. So these are typically better for long-term investors. I would say they're not necessarily good for anybody. But the idea is, Tim, is that, if this particular, say you opened up an IRA with me and I basically charge you an A share commission, this particular fund, I think, basically charges 5.75%. So 5,000 times 5.75%, that's a $287 commission that goes straight to me. So basically when I look at my statement the next time, my statement's going to be like $4,700. It's going to be 300 short. A lot of advisors don't necessarily like to sell those just because it can be very, abrupt for clients. The other way to basically sell these, and I've never sold a B share, and I'm not sure how prevalent they are, but a B share, it's basically, it has high exit fees or when you sell and higher expense ratios, but they convert over to A shares over basically the course of many years. So the idea is that you don't get that kind of abrupt fee, but if you hold the investment long enough, it basically converts into an A share. And I don't have as much experience with these, and I haven't seen these much even on statements. But the one that I do see, fairly often is called a C share. So these have higher expense ratios than A shares and a small exit fee that's typically waived after 1 year. So the idea is that in that same example, if you were to basically put $5,000 into a C share mutual fund, you wouldn't necessarily get hit with a big commission up front. But what's basically on there is, and it's kind of built into the total expense ratio, is 12B1 fees. So this is like a marketing fee. So as the advisor, I would be making, say, like 1% as long as you held that investment. So it's more of a trailing commission that you pay versus an upfront commission. And these could be very prohibitive to an investor. Lots of fees that you really don't understand how you're paying, and the advisor is basically getting paid that marketing or that service fee over the course of however long you've held that investment.
So Tim, let me ask the question that I suspect many of our listeners are thinking, that I'm thinking individually, as you describe A shares, B shares, C shares, on the heels of our discussion of today's day and age, where we can obviously have an option to reduce some of those fees, whether that be upfront trading fees or even ongoing expense ratios. There's other options that are out there. What is the role, if any, for these A shares, B shares, and C shares? Like, are these ever in the best interest of a client? And I say that dramatically, knowing it's not a black and white answer, but why would I invest in an A share, B share, or C share?
So in my experience in this world, you would charge a client, and this is going to be very true for many kind of new practitioners and pharmacists that are out there that are maybe seeking help, and a lot of people that are listening to this. So the industry, and really why I'm here sitting in the seat, and why, Tim, we're partners, it kind of is derived from the story or the way that the industry basically operates. So when I was in the fee and commission, the fee-based world, it was, and I started working with a lot of pharmacists, the going advice was, and I actually remember I have this pivotal memory where I was talking to my mentor, and I think the pharmacist couple that I was working with, they had something like $300,000 in student loans. And I was like, hey, mentor, like, what do you think that we should do with this client? And basically the advice was, to me, to how to advise the client was to say, hey, just tell them the loans will figure themselves out, either do a snowball or something like that, focus on the highest interest first, which is terrible advice, Tim, as we all know that the student loans are going to be more nuanced. And then, because this client maybe had like $20,000 to invest, that's not a lot of money. So like, it was sell them insurance that they didn't need. So whether that was life or disability insurance, and then invest their IRA or something like that. And then just touch base with them every couple years until they have $50, $100, $250,000. And then you can actually, air quote, help them. Oh. The problem with this model, Tim, is that it's not a planning issue. Like, we work with clients that are in their 30s that there is a lot of need there to get their investments, their debt, their cash flow and budget in, their insurance, their credit, their taxes, all humming and, working in a unified fashion, that we're really trying to, take the resources that the client has and apply them in a way that is a wealthy life to them. It's not a planning issue.
Mm-hmm.
It's a pricing issue. And unfortunately, the way that the industry is set up is that, hey, unless you have investments, I can't really do anything for you. And it's because like somebody that with $20,000, that's $200 a year on a 1% AUM. So that's versus if someone had $200,000, 1%, that's 2,000. So money talks, right? So that's where A share and C share and those types of commissions come into play. Is like typically if it was less than 50,000 or typically less than 100,000, you would charge these commissions, especially the A share, because it was a higher upfront, or a C share because it was more, I want to say it was more undetected under the radar. And then you would couple that with a crappy insurance product or disability product that they might not need, or maybe they do need, but you're still making a commission on that. And that was a way for you to help the client and make a little bit of money, feed yourself at the same time.
Mm-hmm.
And I also don't want to paint a picture. Sometimes, like, especially in the fee only community, there is this picture that's painted that like people that charge commissions are evil. They're not. Mm-hmm. It's just a difference in model. And, I was early enough in my career that I recognize, in financial services, that I recognized that there was a better way, and that's being fee only, and that's not charging these commissions. And so I was able to pivot away from that. It's not that they're evil. It's just that I think the model or the system that they're in doesn't necessarily suit itself for a lot of clients. Typically, we talk about this with insurance. Typically, the better the insurance product, is for the person who's selling it, the worse it is for the person that's basically buying it.
Mm-hmm.
So there is this kind of zero sum, so to speak. So if you're out there and you're like, I'm listening to Tim, and I'm going to look at my statement and see if you see like A's and C's next to your mutual fund that says Class A, or just I'm looking at one that says Invesco Equity and Income Fund C. I know at that particular time, he's being charged, in kind of an ongoing trail that's eaten away. And again, like if he's being serviced for that, maybe that's worth it. But in most cases, it's not. I wouldn't say that there's never, a time, but I would say, again, there are advisors out there that will work with you in a fiduciary capacity, and that should be divorced from the commissions that you would make from selling a product. So one of the things that, kind of longer, Tim, like one of the things that I talk about when I was in the broker dealer world, the fee-based fee and commission world, this is a story that I tell, prospects and clients is, I would show up to the office and I would see on my calendar, I'm like, oh, this mutual fund wholesaler is going to come a knocking. And that wholesaler would show up to our office in a fancy suit. He would take basically the advisors in our office, which was me and my mentor. He'd take us out to a fancy dinner, or a fancy lunch, I should say. He would show us fancy glossies about why his funds were her funds were so great. And then he would basically say, hey, when your client, Tim Albrecht, when he leaves his job, or if he has money on the side, like, and he wants to roll over that Fidelity 401k, like, use our funds. And
sounds like another industry I know, Tim.
Yeah, it sounds like drug rep, right? And when I say that, most people are like, oh yeah, like, but here's the difference, Tim. Like, in the medical world, my understanding is that it's illegal for physicians to get kickbacks from pharmaceutical companies, because it taints their ability to prescribe medications without the strings attached, right?
Absolutely. Yep.
But if we compare that to my industry, the financial services, not only is it legal, it's prevalent. So like 95% of advisors out there operate in this manner. So like now, like, no one takes me out to lunch, Tim. Like, no one takes me out to lunch because I'm not incentivized to put someone in these mutual funds, because I don't make a commission from that. So what I'm incentivized to do is to put the client in the best situation across the board, but particularly for, the investments we're talking about, where they're paying the least amount for the most gain, so like, I would get through those lunches and again, and they're not all bad. You would learn something, but you kind of felt like you needed to take a shower because like you kind of, they gave you something, they gave you a nice lunch. So like, you kind of like, all right, well, if this client rolls it over, you kind of feel beholden to them. And I just hated that feeling. And by the way, like if you're putting those sales rep out in the field, that costs money.
That's right.
Who pays for that? The investor does. And that typically means that that fund that you're investing in is going to be more expensive.
Mm-hmm.
So I remember having this conversation, and I was talking to this old wholesaler, this experienced, I should say, wholesaler. And I'm like, and I finally kind of, started to really dig deeper. And I'm like, so how can you guys justify charging 1.5% on your large cap when I could put the client in a Vanguard fund that's 0.05%?
Yep.
And he started talking about like, and again, there was nothing about that I was buying, because it's literally 10 times more. Like it's so much more.
Mm-hmm.
And I just don't think that you get that, that you get that return. So I know a little bit kind of on a tangent there, but to me, it's one of these things that I think as a pharmacist, these are things that you probably aren't looking at, that over the course of years really have a compounding factor, either from a negative perspective, or if you can remove those from, it can be very positive. So it's important to, maybe dust off your statement and look at it and really understand what you're paying.
Yeah. And as we zoom out for a moment, Tim, to that point, coming full circle here, like don't underestimate the long-term impact of these fees. Any one year, especially for those that are maybe getting started with investing and haven't built up, that large portfolio yet, you might look at 1.2, 1.5 and say, like what's the big deal? But if you look at 1.5 as an example versus 0.2 as another example, and perhaps, even an opportunity to get lower than that, over the long range of 30 or 35 years, that's a big freaking deal.
Yeah.
Big deal. And I wrote a blog post a couple years back that we'll link to in the show notes, really showing two side-by-side examples of somebody who's investing over 35 years, another person, same timeline, 1.5 average annual fee versus 0.2. And it ends up being the difference of $1 million. And the title of that article is, Are You Making This $1 million Mistake? And, for some, maybe it's larger. For others, maybe it's a little bit smaller. But I think it's so important that we uncover, understand, and begin to put a plan in place that can minimize, these fees if possible, wherever you have control of doing that. Tim, two perspectives I want to talk about as we wrap up this really important topic. And that's first from the perspective of, hey, I'm listening and I'm at the beginning of my investing journey. What can I do? And then somebody who's listening and says, I'm more in the wealth building phase. I've been investing. Maybe I've got a loose understanding of some of these fees, but I'm not exactly sure. And what can I do and pivot now? And is it perhaps too late or not? So what would you say to those two individuals? One who's just getting started, what tangible steps that I can take, and somebody who's maybe a little bit later on their journey and wondering, is it too late? And are there steps that I can take to help reconcile some of this issue around fees?
Yeah. So I think for both of those buckets of people, I think it really goes back to like, what are your goals, right? So like, I think some people, they work with an advisor because they think that's the right thing to do. And the advisor, unfortunately, sometimes it's like every solution is the same. So everyone needs insurance and I need to make that commission. And that's not true. I think it's really understanding what your goals are. And that's the first and foremost thing. And I think from there, if you're at the beginning of the journey, I think it's ask questions, if I'm looking at my 401k statement, like I want to understand, like, why am I paying these fees? A lot of 401ks, they have these managed solutions. And I'm like, well, what do you get for that? And most of the time, like, it's not a whole lot. Same thing, like if you're at the beginning and you maybe, you were contacted by an advisor in pharmacy school, chances are, if you started working with them, a lot of those in mutual funds and, IRAs, and even, we just signed on a client that was sold this, recently, and we're like, it's a kind of a process of unwinding them. Mm-hmm. It's really, being cognizant of this, and like, don't sweep this under the rug, right? So like, it's definitely something that can compound over many, many years. So you want to get it right out of the gate, and it isn't ever too late. So for the wealth building phase, there are people that maybe have been working with an advisor for a long time, or maybe their advisor is someone that's been in the family. Things have changed. So like even 10 years ago, what was offered in terms of high expenses and commissions and things like that, that day is thankfully, dying with the advent of like Vanguard and really trying to drive fees down and things like that. But I look at some of these well-known institutions that a lot of pharmacists work with. There's just there's a better route. So like, I'm looking at this particular statement, and the all in for what this particular client was paying on commissions and everything like that was something like 1.75%.
Sheesh.
And if I compare that to like what we do, like if we were to move that into an IRA, it's like 0.05%. And it almost sounds like fake. It sounds like it's not real. But the reality is like if you can get your money in a position where it's unadulterated by those kind of and I could say they are kind of hidden, because like if you look at the statement and I search like commission or fee, it's non-existent. There might be like a fee, disclaimer in the small print, but again, it's not a line item that's very like obvious to the investor. So I would just say, like I would question, again, if you're in a wealth building stage, I would question what you're currently in and if there's a better way, just like we do with like car insurance and things like that. There are opportunities out there to potentially, be in a better position to, again, really allow you to build money and grow wealth over time.
Yeah. And Tim, I would wrap up here by telling our listeners and community, whether you're at the beginning of this journey, whether you're in that wealth building phase, whether you're somewhere in between, I think this obviously is such an important topic. And we would love to have the opportunity to talk with you to see if what we offer at YFP Planning is a good fit for you and your individual plan and situation. And folks can find more by going to yfpplanning.com. They can schedule a free discovery call. And I'm going to toot our own horn for a minute, but I'm so proud of what we have built, Tim, really what you have built starting back in the days of Script Financial, which is a fee-only comprehensive financial planning model. And one of the things I so appreciate about that model is it's fully transparent. The fees are the fees in terms of what we charge for our services, and the client is paying our financial planning team for the advice that they're giving related to their financial plan as a whole. So, whether that means we've got to spend, a boatload of time on the investments and the retirement side of the plan, whether that's we need to spend some time on the tax side or the insurance side or the student loan side or the home buying side, whatever would be the aspect of the financial plan by nature, because of how that client is transparently paying for the advice and the transparency of those fees, we can spend the time where we feel like it's most needed for the client and their financial plan, and ultimately is in their best interest. And so, that's a model that I'm really proud of that we offer to the YFP community. And for folks that are looking for a financial planner or perhaps reevaluating the relationship they have currently, head on over to yfpplanning.com and you can schedule a free discovery call. Tim Baker, great stuff as always, and appreciate your time and expertise here as it relates to the discussion of fees, and looking forward to upcoming content we have for the second half of 2021.
Yeah, thanks, Tim.
As always, a thank you to the listeners for joining us on this week's episode. And as we wrap up this first half of 2021, we appreciate you listening, but also would appreciate if you could leave us a rating and review on Apple Podcasts, which ultimately helps other people find this show. Our mission is to help as many pharmacy professionals as we can on their path towards achieving financial freedom. And one way we can do that is by reaching more people with this show. So if you haven't already done so, please do us that favor, leave us a rating and review. And ultimately that will help others find the show in the future. Thanks for joining us and have a great rest of your week.